Looking to buy a home in Central Texas right now, you will quickly learn that it is truly a seller's market.
Texas homebuyers aren't walking into a stable market. They're split right down the middle. 39% say they ran into bidding wars on the homes they wanted. 57% didn't face any competition at all. Yet the biggest barrier isn't speed, it's cost. 42% of buyers stopped searching altogether because prices were simply too high. Another 30% walked away because the homes they could afford didn't have the features they needed. Most didn't give up after one try. 63% had to make offers on multiple properties before anything stuck. And to stay in the game, half of all buyers ended up increasing their price range just to compete. Texas didn't stumble into this moment. It was built on years of fast growth and uneven pressure. Buyers expected the market to be picked clean, but that's not what they found. 2/3 of respondents in the new Texas Realtors poll said there were enough homes to choose from when they were looking. Only 20% said inventory was lower than expected. Even the search experience shows how the boom evolved. Nearly 44% of buyers toured between 4 and 10 homes. Another 13% needed to see 11 to 20. A small but determined 4% pushed past 20 showings. This isn't casual browsing, it's buyers trying to decode a market that still looks hot on the surface. Time pressure tells another part of the story. Only 18% said they felt rushed to make an offer before losing a property. That means the classic bidding window panic has faded, but it hasn't disappeared. Some buyers are circling, some are stalling. The split is regional, not statewide. That's exactly how realtors describe it. In the poll, one Austin broker called Texas an orchestra of micro-markets, where one zip code is cooling while another is still white-hot. Builders are adjusting quietly, sellers are testing new price ceilings, and buyers are entering with wildly different expectations. Some thinking they're in control, others bracing for another round of rate hikes. The appetite for long searches shows how migration and price momentum reshaped the state over the last 3 years. The buyers now in the market are either pausing, stretching, or recalibrating. Many came in assuming scarcity. Instead, they found choice, but not always affordability. That disconnect is why mixed perspective isn't just a polling headline, it's the operating condition of the market.
Even the act of viewing homes reveals a cooling undercurrent. Touring 10 homes would have been unthinkable for most buyers during the frenzy years. Now it's standard. The run-up in prices during the pandemic pulled inventory forward, then stalled at the top. New household formation and migration inflated demand during 2020 to 2022, but not evenly across regions. The polls reflect the aftermath. Buyers willing to search widely, but less willing to overpay instantly. The reset hasn't canceled ambition, it's reorganized it. Some buyers came in ready to wait. Others came in thinking they had leverage. The result is neither a buyer's market nor a seller's market. It's a zone of hesitation, fueled by a long boom that still echoes in prices, listings, and expectations. Texas didn't cool off evenly, it fractured. And that's where demand, risk, and strategy begin in this script. The Texas market isn't filling up with first-timers anymore. It's tilting toward older, wealthier, and more insulated buyers. The polling shows how the demand profile has shifted, not just cooled. Start with financial positioning. Half of all buyers increased their price range during the search, a sign that expectations bent toward market pressure instead of pushing back. At the same time, 31% lowered their price range, either due to fatigue, financing limits, or lack of options in their original bracket. That split creates uneven confidence and uneven urgency. Multiple offers are no longer a luxury tactic, they're standard behavior. 63% of buyers made offers on more than one property. That means most shoppers knew their first target would probably slip away or get outbid. The result is a buyer pool conditioned to compromise and expand budgets instead of exiting entirely. But the bigger divide is who can afford to play that game. Fewer buyers are relying on family gifts or outside help. Nationally, the share of first-time buyers dropped from 32% in 1981 to 24% today, and their median age has climbed to 38. These aren't entry-level participants. They're mid-career earners moving capital, not scraping for down payments. Median income for these new buyers is now $97,000, up sharply from previous generations. That kind of earnings base changes how people react to price jumps, interest rate swings, and competition. It also explains why some buyers consider the current market workable. They're not measuring affordability the way entry-level households do. And then there's the silence underneath the polling: investors. While the survey doesn't break them out, the purchasing behavior points to segments with padding. Buyers increasing price ceilings, writing multiple bids, and stretching searches across double-digit home tours. The ones leaving the market, the 42% priced out or the 30% who couldn't find required features, are the ones without that flexibility. Demand in Texas is no longer a line, it's a ladder. The higher rungs are still climbing. The lower rungs are slipping off.
And as long as the buy side is dominated by people who can widen budgets instead of walk away, the market won't crash. It will stratify. Insurance isn't a headline in the polling, but it's a silent factor shaping the stress buyers report. When 42% of would-be buyers say they stopped their search because prices were too high, they aren't just reacting to sticker shock. They're reacting to the full monthly stack: mortgage, taxes, HOA obligations, and increasingly, insurance premiums. Texas is a state where storms, flooding, and fire designations can reshape borrowing terms in a single afternoon. That doesn't show up as a dedicated survey question, but it shows up in the behavior. 30% of buyers who gave up entirely say the homes they could afford didn't offer the features they needed. In a market where roofing age, elevation, and structural condition can swing premiums by hundreds per month, features often means cost shields. Look at the buyers who kept going. Half of all participants raised their price range mid-search. That doesn't just suggest aggression, it suggests buyers running into unplanned expenses during due diligence. Financing approvals tighten when insurers pull back. Inspectors flag risk caps. Lenders rerun ratios. The poll doesn't say that directly, but the behavior tracks with it. There's another tale: touring churn. Nearly 44% of buyers saw between 4 and 10 homes. Another 13% saw 11 to 20. Some went beyond 20. When inventory is enough, as 2/3 of respondents claimed, but selections still fail, it's not aesthetics holding them back, it's cost viability. If a roof, flood zone, elevation rating, or outdated system kills a deal, it shows up in the stats as kept searching, not insurance barrier. That's how hidden shocks move silently through a market. Carriers don't need to exit for buyers to feel exposed. Premium deltas don't need to be quoted for wallets to seize up. The proof is in the stoppage patterns. The people bowing out before making a final offer, or the ones stretching to stay in play. And the divide is widening. Sellers with low carry policies from earlier years don't experience the same burden as buyers stepping into new coverage cycles. So the listing price doesn't reflect total payment reality. The poll responses reveal that split without naming it. Texas doesn't need a named storm or legislative fight to trigger hesitation. The insurance shock is already priced into the fatigue, the abandoned searches, and the widening price bands. The buyers feel it, even when the survey doesn't ask the question. Affordability in Texas isn't a question, it's a filter. Buyers are entering the market knowing they'll spend more than planned, and many still reach the breaking point mid-search. Start with the clearest signal. 42% of buyers walked away because prices were too high. That's not hesitation, that's a hard stop. And those who stayed didn't do it by finding deals. They did it by stretching budgets. 50% increased their price range just to keep looking. But stretching isn't the only tactic. 31% lowered their budget midstream. That's the flip side of the same pressure. Buyers pushing their ceiling until the numbers collapse, then resetting expectations downward. These aren't luxury buyers. They're people trying to salvage eligibility.
Demand behavior confirms it. 63% had to make offers on multiple properties before moving forward. That suggests financing terms, appraisal results, or monthly payment projections derailed earlier attempts. When mortgage rates move, so do debt-to-income ratios, and buyers don't always realize that until they're under contract. Time pressure is where the psychological math shows. Only 18% of buyers said they felt rushed to make an offer. That means most weren't sprinting to win, they were calculating to survive. It aligns with reports of touring volume. Nearly 44% viewed between 4 and 10 homes, and another 13% viewed up to 20. If prices were the only barrier, they wouldn't invest that much time. The friction is cumulative: rates, taxes, fees, inspections, assessments. Inventory isn't the soft landing many expected. 2/3 of buyers said there were enough homes to choose from when they searched, but availability doesn't equal attainability. When the cost stack rises faster than wages, enough inventory becomes a mirage. You can see it, but you can't hold it. The wealth gradient from the national buyer profile makes the split worse. The median first-time buyer now earns $97,000, and their average age is 38. Those are not entry-level numbers. They're survival numbers for a market where cash cushions matter more than timing. Buyers without those buffers fall into the 42% who leave the game altogether. Even those who stay feel the undertow. The people increasing budgets don't see it as confidence. They see it as the cost of admission. And when they finalize offers, they're not just competing with other buyers, they're wrestling the math itself. Texas isn't unaffordable for everyone. It's selectively affordable for those who can bend, stretch, or escalate. And that reality defines the pressure in every offer, every tour, and every quiet exit from the market. Texas buyers aren't struggling to find homes, they're struggling to land one. The poll makes that distinction clear. 2/3 of respondents said there were enough homes to choose from when they were actively searching, but choice isn't the problem. Conversion is. Start with competing offers. 57% of buyers said they didn't face any competition at all. That sounds like leverage, until you set it next to the 39% who still entered bidding scenarios. The split means liquidity is fractured. Some homes sit, while others trigger an instant scramble. Offer churn tells the deeper story. 63% of buyers had to write offers on more than one property. That's not impatience, that's deals falling apart. Financing denials, inspection fallout, appraisal mismatches, or walkaways over cost. The survey doesn't list the reasons, but the behavior maps to friction in closing, not indecision. Touring volume backs it up. 44% toured between 4 and 10 homes. 13% saw up to 20, and 4% pushed beyond that. In a market that supposedly has enough inventory, that many viewings means buyers are getting stuck, not moving smoothly from walkthrough to contract. Then there's the budget reshuffle. Half of all buyers increased their price range mid-search. That's not liquidity, that's forced escalation. And when 31% lowered their range instead, that signals retreat after failed attempts. Either way, the search process isn't linear. It's a negotiation with reality.
Even the absence of urgency is a red flag. Only 18% said they felt rushed to make an offer. In a true buyer's market, that would mean control. But here, it means caution. Buyers slowing themselves down because they know terms can collapse late in the process. The exits explain the rest. 42% of buyers simply stopped searching because prices were too high. Another 30% said the homes they could afford lacked the features they needed. When buyers quit before closing, liquidity dries up invisibly. The listings still exist, the deals don't. The old boom logic, list, bid, close, doesn't apply cleanly anymore. Sellers can't assume automatic absorption, and buyers can't assume they'll finish what they start. The poll doesn't reference cancellations directly, but the high rate of repeated offers and abandoned searches signals disruption at every stage. Texas doesn't look frozen from the outside, but underneath, it's a market where deals take multiple attempts, budgets bend until they break, and confidence hangs on the thinnest math. Liquidity isn't gone, it's splintered. The Texas market doesn't need a hurricane, wildfire, or legislative bombshell to freeze activity. The stall is already baked into buyer behavior, and the polling reads like a slow-motion trigger. Start with pacing. Only 18% of buyers said they felt rushed to make an offer. That number would be unthinkable during the peak frenzy years. The pressure isn't external anymore. It's internal. Buyers aren't sprinting, they're bracing. Inventory tells the same story. 2/3 said there were enough homes to choose from, but that hasn't translated to quick movement. If a market has choice and buyers still hesitate, something else is slowing them. Underwriting risk, payment uncertainty, inspection fallout, or fear of overcommitting in the wrong week. Search abandonment is the loudest freeze signal. 42% stopped looking because prices were too high. That's not fatigue, that's surrender to math. Another 30% walked because the homes in their price band didn't meet required features. In a confident market, buyers compromise. In a stressed one, they back out completely. Budget drift shows the instability too. Half of buyers increased their price range to stay in play. That means they were hit with surprise costs, failed bids, or underwriting obstacles. Meanwhile, 31% lowered their price ceiling, signaling failed attempts or lost confidence. Escalation and retreat in the same dataset is a hallmark of a fragile market. The search timelines reveal the stall too. Nearly 44% viewed between 4 and 10 homes, 13% saw up to 20, and a determined 4% viewed more than that. When deals aren't locking, timelines stretch, and the trigger becomes invisible but constant. Then there's the split in competition. 57% faced no competing bids, while 39% did. That kind of unevenness keeps buyers guessing. One listing looks dead, the next erupts. You don't rush into that, you pause. Even the demographic shift creates drag. With the median first-time buyer now 38 years old and earning around $97,000, the pool skews toward planners, not gamblers. Those buyers don't move just because rates dip or inventory bumps. They move when long-term risk feels containable. Nothing in the polling points to a singular shock. The freeze is cumulative. Cost pressure, failed offers, feature gaps, uneven inventory, and the psychological drag of a market that doesn't reward speed anymore.
Texas isn't stalled by disaster, it's stalled by uncertainty, and that makes recovery slower, quieter, and harder to predict. Policy isn't the headline in the polling, but the fractures show up in how the market is being interpreted, not managed. The Texas Realtor Survey itself is a signal. This is the first statewide buyer poll the group has ever conducted. That alone suggests the industry is trying to understand something they aren't getting from closings and MLS data. Realtors in the report don't talk about laws, they talk about fragmentation. One Austin broker calls Texas an orchestra of micro-markets, where pricing logic, inventory flow, and buyer urgency shift neighborhood by neighborhood. When markets break into pockets, coordination becomes impossible. Local governments, lenders, insurers, and agents stop tracking the same reality. There's no mention of statewide intervention in the polling responses, but you can see where it would collide with lived behavior. If 2/3 of buyers say inventory is sufficient, but nearly half of them stop searching due to costs or mismatched features, then supply policy alone won't move the needle. Affordability, not availability, is the choke point. Confidence isn't unified either. The poll doesn't ask whether buyers trust state leadership or local regulators, but their actions hint at divided expectations. 50% increased their price range to keep playing. 31% lowered it to survive. 18% felt time pressure, meaning the rest didn't think the market could outrun them. Those aren't policy reactions, they're reactions to uncertainty. Even the commentary around pricing reflects quiet turf friction. Buyers aren't behaving as if conditions will improve in their favor through intervention. They're adapting individually. Realtors didn't cite new laws or incentives in their explanations. They cited adaptation, caution, and disjointed local conditions. That's what a market looks like when policy isn't steering momentum. Behavior is. This section doesn't speculate about new legislation, insurance mandates, appraisal reform, or county-level zoning shifts. The polling doesn't mention them. What it does show is a landscape where no single entity, not the state, not lenders, not builders, is clearly guiding outcomes. The data points to a market operating on improvisation. Policy doesn't need to fail loudly to lose influence. Sometimes it just falls behind reality. And in Texas, reality is being rewritten zip code by zip code, faster than any statewide strategy can catch it. Texas doesn't have one housing market. It has layers. The polling exposes that without naming a single metro. Start with how buyers describe availability. 2/3 said there were enough homes to choose from, yet 20% said inventory was lower than expected. That's not confusion, that's geography. In some zip codes, listings are sitting. In others, buyers still feel squeezed. Competitive pressure tracks the same way. 57% of buyers faced no other bids, but 39% walked directly into a bidding fight. That means one street can feel like 2021, and the next can feel like a slowdown. It's not statewide logic, it's pocket-level economics. Tour volume maps submarkets by friction. Nearly 44% toured 4 to 10 homes, another 13% toured 11 to 20, and 4% saw more than that. Buyers don't invest that much time unless some markets are overloaded with mismatched product or keeps breaking before closing. Affordability splits reinforce the latter effect. When 42% of buyers stop searching entirely because prices are too high, the drop-off isn't even. Entry-level neighborhoods stall first. Mid-tier suburbs hold on longer. Higher-income enclaves stay liquid because financing can stretch. But the poll shows who stretches. 50% increased their price range, while 31% lowered it. Those two moves don't happen in the same zip code. They happen in different ones. Feature gaps reveal another divide. 30% of buyers who quit said the homes they could afford didn't have what they needed. That points to older stock in cheaper markets, upgrade-heavy new builds in pricier ones, and mismatched supply in the middle. In resilient areas, buyers compromise on layout and keep bidding. In stressed ones, they walk. Confidence is also local. Only 18% felt rushed to make an offer. That means most buyers believed the homes in their target area wouldn't vanish overnight. In a high-velocity submarket, that number would collapse. Here, it suggests a mix of slow zones and fast corridors, not a unified trend. Then there's the comment that ties it together. A Texas broker in the poll calls the landscape an orchestra of micro-markets. That's not metaphor, that's practical. Houston doesn't behave like Austin. The Dallas suburbs don't mirror San Antonio, and within each, the zip-to-zip behavior is even more fractured. The polling doesn't rank cities. It doesn't need to. The behaviors draw the ladder. Top rungs. Buyers increasing budgets, facing bidding wars, touring many listings. Middle rungs. Buyers recalibrating price bands and making multiple offers. Bottom rungs. Buyers exiting after one failed attempt or never starting. Texas isn't one market moving slowly. It's 6 moving at different speeds, and some are already stuck, while others still sprint.
The Texas market isn't cooling or crashing, it's splitting. Buyers are still active, but not evenly. They're bidding, backing out, stretching budgets, or walking away entirely. The poll doesn't show confidence or panic, it shows calculation. Start with the quit rate. 42% of buyers stopped searching because prices were too high. Another 30% abandoned their plans because the homes they could afford lacked the right features. That's not temporary friction, that's a structural filter. But the ones who stayed didn't do it by waiting for prices to fall. Half of all buyers increased their price range to compete. 63% made offers on multiple properties. People are absorbing the cost, not outrunning it. Competition isn't gone either, just concentrated. 39% faced competing offers, 57% saw no bidding pressure at all. That's how a market looks right before it resorts between winners, watchers, and walkaways. The next 6 to 12 months won't hinge on inventory alone. They'll hinge on who can still stretch, who refuses to, and who times their exit or re-entry around financing terms and insurance risk. 39% faced competing offers. 57% saw no bidding pressure. 42% stopped searching over price. 30% quit over missing features. 63% wrote multiple offers, 50% increased budgets, 31% lowered budgets, 44% toured 4 to 10 homes, 18% felt time pressure. 2/3 said inventory was sufficient. Texas isn't pausing, it's sorting, and anyone buying, selling, or investing now is either adapting or stepping aside.